Hey guys, it's time for PayPal earnings. So welcome. Amir is with me today, and Couch Investor will be joining us in a little while. Um, Today's a big day, Amir. What are you thinking?
Yeah, are we leaving PayPal behind us, or is 2026 another transition year? It's kind of exciting. It's no Palantir. We had Palantir. I know you're into that stock as well. Yesterday,
Oh
it's probably
man,
not going to be one of those, but exciting nonetheless. They tend to talk a lot during these, a lot of so far empty promises. So let's see if we actually have any progress on the multitude of exciting projects that they've shared with us.
yeah, we really need to hear like that. That's where I'm at, and I've been full disclaimer. Like this is a critical earnings for PayPal. Honestly, I thought it would be the inflection point, but we've seen some weakness, not just in terms of macro, but in terms of and in the stock price, of course, but in terms of execution too. That things have been taking longer, they've been slower. It's classic PayPal. Now I do think they're heading in the right direction, but like in my mind, basically as I'm entering this, I'm like, okay, is are there better opportunities out there? And really, until we get the earnings, we hear the guidance. The good thing is, we know that this is a company that, if they put out numbers there on guidance, they're going to hit those numbers. So it's not a question of like whether or not they'll put out numbers that they're not going to reach realistically. And it's not all about numbers too. There's certain projects that have just disappeared off the radar, like Fastlane. Does it even exist? It does. I'm just kind of joking. Advertising, where are they at? What's
Agentic
going on here?
commerce, what's happening? They
Yeah.
just acquired Symbio, like all of these like PR news, but we're like, okay, but when's it actually happening? I just recently moved to Japan, and when you like, I had to buy like refrigerators and stuff, TVs. Like, I'm using AI constantly, like comparing products, like having help find the right product because I'm kind of clueless on most home appliances. Would have been great to have some PayPal, like click to buy, but it's not available. So what's happening with that?
Yeah. And the other factor too is this is analysts really only care about one number. It's branded, and we know branded is going to be not great. Branded is already not going well enough, and it sounded like that branded would also not do well at all based on some of the stuff that's in the macro. And I know I've had comments on this in the past, but strong companies don't talk about the macro that much, even when things are not that great. Weak or middling companies do, and PayPal's talked a little bit too much about the macro and their weakness there. So we'll have to see what happens. By the way, any stock move before earnings are actually released, I wouldn't read too much in that. That's just traders trading and speculators speculating. We also, as a word of caution or encouragement, depending on what happens, we saw last time, Amir, a massive pump in earnings, like really good, solid numbers. The numbers are not the problem with PayPal. Of course, the
Yeah.
OpenAI partnership as well 3 months ago, and we saw like plus 10% something gain, and then that faded, and here we are now near a low that was set back in 2017. So absolutely disgusting.
Yeah, it's kind of interesting that they were so cautious about the consumer in Q4, but so far we haven't really seen like the earnings that we've gotten so far. Like, not many people seem to share that sentiment. Actually, it seems that consumer is doing just fine from the earnings that we have gotten. So I'm curious what that was all about. And do you know what the street expects for branded? If they
Yeah,
can like keep it high single digit, that's probably best case scenario, right? If that.
those are expectations that they kind of don't put out there, very very often. Like analysts will put that in their analyst notes, but there's not a. I don't think Fiscal AI shows branded expectations. They do show free cash flow expectations. Which, by the way, that's one of the things that'll be a highlight when they come out because they've reiterated like multiple times every single earnings. We're gonna hit between $6 to $7 billion in free cash flow. You see what they put out so far this year or last year rather. So we know it's going to be a colossal number. And for some reason, analysts are like way under that number. I'm like, I don't know what's going on there. But again, analysts don't care about free cash flow. They don't care about money. They don't care about EPS. They don't care about anything except for PayPal branded. That doesn't mean, by the way, that the stock can't go up. Like that's the other nice thing about this earnings is expectations and sentiment are so low. It doesn't take much for this to see, massive rally. And so it's painful. We'll have to see what's going to happen here. But what are your guesses? What do you think we get today?
I've been saying this for a while. As long I think the stock will, everyone and their grandparents knows that PayPal is seemingly cheap, seemingly undervalued, but we haven't really gotten that one single positive catalyst to hang on to. We haven't gotten any tangible progress. So if we actually start to see something like that, I think that the stock can move very rapidly upwards, aggressively. But if that doesn't, if you would ask me, can we see something in the 40s range? If you would have asked me last quarter, I said no way, it's not going to happen. Yeah. But here we are on the cusp. But
here we are.
I'm also curious about one major thing about the buyback situation. Sorry.
One moment. We have another guest. Juan.
Good morning, everyone.
Good morning.
Hey.
Welcome. Glad you could join us.
Nice to finally meet you all. I think I have some breaking news. We have a new CEO. Is that correct?
I'm seeing people are saying Alex Chris is gone. So let me pull that up. That would be
crazy.
Yeah. I may be out. We'll have to see, but curious what brought that on too. I mean, obviously stock price is not good, but
PayPal has a history of activist investors meddling and putting on pressure and stuff like that. So I'm curious, what the board of the directors are like and what they're kind of evaluating. But
I don't think people have said out there that PayPal's intentionally suppressing the stock to buy back more, and they don't do that. Internally, it's demoralizing. Externally, it's demoralizing. It just, and then you lose your job if it's persistently this way. So, I'm seeing.
Do you guys believe it's
it
justified? Assuming that this has happened, do you believe it's justified?
No, I think this is a massive. This is a massive enterprise.
For personal reasons, right? Because that could be,
Yeah.
I mean, he inherited a mess, and it takes time. It is a legacy business. The legacy platform is still widely, spread out there among the merchants. It takes time. I get that. So I don't know if patience ran out or what's the reason here.
Yeah, I'm trying to find it from a credible link. If somebody does have it.
Report and slides are out. What?
Wow, that's fast too. Yeah, it says Enrique Lores is the new president and CEO of PayPal. Yeah, interesting.
And apparently it's a miss on earnings.
All right. Classic PayPal.
You know what? I wouldn't be surprised if the stock is up on CEO change. Who's this Enrique Lores guy?
Maybe. Yeah, give us a nice dead cat bounce.
CEO of HP. Okay. What's he doing at PayPal?
I don't know, but here's what we have in terms of quarter four. So this stuff, I mean, it does matter, but it doesn't really matter. So let's look at the actual numbers. So fourth quarter and financial year 2025 standpoint, we can see year-over-year growth. I mean, total payment volume is one thing, but revenue, this is dismal. 4% revenue growth, 3% dollar neutral. So they're helped by a weak dollar. This is for fourth quarter. For the full year, we're looking at 4% transaction margin dollar growth, just terrible. Frankly, adjusted free cash flow. So unadjusted is probably higher, but that is not great at all either. Non-GAAP EPS 3%.
No growth in accounts either.
This is fine. The month, honestly, monthly active is not as good as you would hope, but I mean that's not the most important number there. Let's see where branded went. So branded experiences, which analysts don't care about, was 4%. Wow, yeah, branded checkout 1%.
Wow,
that is
1%.
That is worse than I was thinking. I was like, there's a chance we come in with 3%. 1 is just horrific. So,
Well,
yeah.
well, I get the cautious comments leading up to their earnings now. This is not
All right.
pretty.
So, guidance here: transaction margin dollar slight decline for the full year. Roughly flat transaction margin dollar, 3% non-GAAP growth, GAAP EPS mid single digit decline. Yeah, I'm probably out, guys. We'll still cover the call together, but yeah, I don't think that I want to be in another transition with another CEO that I'm not understanding here. So, yeah, that's not great at all.
You know,
All right.
my whole intrinsic valuation is basically as long as they don't, as long as they keep growing, it is severely undervalued. They are rapidly approaching that point of, not growing. it's
Yeah,
it's
here's the
coming
free cash
along.
flow. So they did 6.4 billion total. So it was, but yeah, that's an adjusted free cash flow. Unadjusted free cash flow, yeah, that's also terrible too. So I don't know if there's anything good here. Wow.
Let's see if there's some. Oh, Jamie Miller, interim CEO. Okay.
Oh, Jamie is okay. All right.
Yeah,
I
whatever.
wonder
It doesn't
what
matter.
went wrong during the quarter because Alex Riz, he sounded very excited during the Q3 earnings, and
Yeah.
earnings were good. They said they had momentum, but sometimes the market gets it right, and apparently they were right here because we're not gonna see any growth next year. Well, this year in 2026. So
Yeah, this will take a while to digest, but I mean, damn, I'm kind of surprised. As you mentioned, he's been very, very optimistic every single earnings call. We've been sold like all of these new partnerships. Everything is progressing at the frontier of the next era of finance. Doing all of these partnerships with Google, with Mastercard, with like acquiring Symbio, OpenAI, and nothing is materializing. Even like Fastlane, like I haven't encountered, better checkout experience. I would have probably by now, given how much I shop online, never came across it. So like all of these, like it sounds good, and more importantly, what's happening to the ads business? That could be like on its own, the ads business could probably be worth the whole market cap of PayPal now if executed well. Like what's happening with that? That's been in the pipeline for 2 years, like no progress. So
We're at 46.82 in the pre-market, down 10.5%, and I can't say it's unjustified. I mean, it could fall further. The business, it's still making money. It is a stupid valuation, but at this point, yeah, especially with that guidance with transitioning to another CEO, this is not worth my time. So, I mean, not talking about this earnings call, guys. We'll cover it, the highlights and the low
he says that
lights.
sitting in a PayPal shirt.
No, if I had another shirt, I'd like rip this one off, burn it, take another one as well. So, yeah, take a big L. I was wrong. I was completely wrong on PayPal. Yeah,
not even
happens.
the OVA's revenue only grew 10%, down from 15% in Q3. International revenue only grew 1%. It grew 7% in Q3. There's
Look how they're like
nothing good.
starting to break out new metrics to make it like sound like there's some growth. Enterprise payments TPV growth.
Well, on that, like, I don't know that they're necessarily doing it for that reason, but like
Well, no,
that's
but
always
I
something
mean,
that I've wanted to know is like what percentage actually the total payment volume is enterprise or not. So like, I'll give them credit on that. I'm not going to give them very much credit on this earnings. It's abysmal. Wow.
it's also crazy to me that consistently one of the highest and basically in line with sales and marketing is customer support expenses, and it has been so high for so long, and we're in like an era of AI. Like how difficult is it to like adopt some agent that does your customer support? Why are you spending $250 million per quarter on customer support. Like, how many people do you have employed? And from what I'm hearing, people are very dissatisfied with PayPal customer support. Like, what are you paying like $500 million for per quarter? Like, I never understood that cost.
Couple decades ago, it used to be pretty amazing, and now it's just no. It's been not good enough. AI should have been able to help them with that, and there's a way to implement it that's absolutely terrible. But yeah, I'm actually selling my shares right now, guys. I don't care.
As we're speaking.
Yeah,
But it wasn't that big of a position for you, right?
it was about 10. Well, once upon a time, it was about 10% of my allocation.
Oh,
Well under
that's like
that
your
now.
max, right?
Yeah,
Your
that's my
portfolio size.
max unless like it just accumulates through performance and price increase, or if it's like a Palantir. So, and sometimes I'll build like SoFi right now is so undervalued that I ended up adding some to my swing portfolio beyond what I normally allocate. But that's not stuff that I'm going to hold necessarily like
Damn,
just
I'm
for.
looking at the comments. People are like exiting their positions in the chat as well, liquidating. Well, I'm not gonna be hasty. I'm gonna, take my time, look at it properly, try to see if there's some angle. But the optics are not good. It does seem like the market is correct, and I've been preaching the gospel of like this seems crazy, but apparently crazy can turn out to be correct. Like I didn't expect it to deteriorate to this degree.
Yeah.
Yes, it's headed in
total
that direction for sure.
Yeah, the sad thing is like we've seen after last quarter, which again it was a really good quarter, but there were some issues, but largely it was related to what they were expecting for quarter four, macro stuff as well. And we saw downgrade after downgrade. I'm like, this is probably too far down. We're going to probably see PayPal, in the mid 40s, maybe lower, and also still downgrades. And that's just sad. So yeah,
there is also the reality that they are, making in excess of $6 billion of free cash flow per year. The market cap is quickly approaching, towards like 30 billion ish. Like it doesn't take a lot to repurchase all the outstanding shares at this rate. And the question is like, what then? Like there has to be some kind of cap, some kind of ceiling on downside. But as for upside, I don't know where it's gonna come from. I believe that
yeah.
there's still like a cap on like how low it can go. So it's not like they're not gonna go bankrupt. I mean, they are generating cash, they are buying back in shares. Obviously, they also still think that it's undervalued. Even with these numbers, I think it's undervalued. But as Crossroads mentioned, like there is opportunity cost in the market. Some people, including me, have been in this company for 2 to 3 years. We have not seen any progress. We've seen the deterioration like over this 3-year period. So, I mean, yeah, opportunity cost is a real thing. Is downside capped? Probably. What about upside? I don't know. Is my mic bad? Someone is saying that my mic is bad.
I think, Juan, it might be yours. So just when you're not talking, if you can mute it
Yes.
and then just unmute it, then that'll be perfect.
Oh yeah, I can hear some typing or something, like some clicking or
Yeah.
some.
Yes, I was just checking the shares outstanding, 920 million, probably close to 900 million now. But
Yeah.
that will not do it. Buybacks,
Yeah.
they will not do it.
Yeah, buybacks and valuation are never like enough for a thesis. It's enough to protect you from some downside. The problem is again deceleration, and then if you switch midstream, which they're effectively doing with Alex Chris gone, like is that same strategy there? Can we count on the buybacks? Like the board of directors could also have changed that or be in the process of reconsidering that. Like we don't know. Is this perhaps something that an activist investor came in and is working to like kind of right the ship in their mind? We saw that with Dan Schulman, the previous CEO, and Elliott Investing. So lots of questions, too many for me. I've sold all of my shares. I still do have a small bit of options, which is probably worth absolutely nothing now. But I thankfully I'd sold a lot of mine back in December, where I was like, shares yes, options no. Now no shares either. So
I thought
What
I
are you
was
guys
so
doing?
clever.
Go ahead.
Sorry.
Amir.
I thought I was so clever buying $65 call options. I'm like, dude, this is easy money. I don't even want to look at those now.
With
Probably right.
expectations so low, it should have been, but no. Yeah, apparently not. Juan, what are your thoughts as far as like your position? Does this change the thesis for you, or are you looking to get out, or are you saying, hey, it's there, it's not great, but it's like the valuation still is ridiculous?
100%. One of my reasons why I was still in there was Alex Chris. I thought he was doing a good job, but again, I don't know what happened in Q4, but something happened. The strategy is clearly not working, and we don't know where the next CEO is gonna, in which direction he'll head, and whatever he does, it's gonna take some time. Growth is definitely slowing, and it's hard to find any reasons to hold the stock, especially when you have SoFi trading at $22 like it is today, getting an
Yeah,
upgrade from JP Morgan. I don't know if you guys saw that. That's
I
why
did. Yeah,
it's up in the pre-market.
yeah, up quite a
And
bit.
you have other stocks going down, Robinhood, other stocks, other opportunities out there. So I honestly don't see myself holding the stock much longer unless we see something crazy in the call
We
that
need the Neil
catches
in
our
here.
attention, which Jamie Miller
Yeah,
will be speaking, so we shouldn't
I
expect much.
no. She does bring a lot to the table, but not as far as speaking. Neil, when you're ready, you just give us a signal. It looks like he's getting ready to come on, and maybe he'll have a different view. By the way, guys, this is not financial advice. You know, you don't. As you know, you're holding. If you're holding PayPal, don't just follow us just because we're in something. We get a lot of things right, but we also get some things wrong. And the reality is, you know your situation better than we do. So, but the way that I look at it is when you are investing in a stock and the thesis actually changes, it's oftentimes not worth just holding on to, hoping that it'll rebound, that you can at least break even. That is a real opportunity cost. I've seen this before when my portfolio was not where it needed to be in 2021 through 2022. We went to the bear market. A lot of the companies that I was investing in just were not worth my time. Palantir was falling like everything else. And I was like, you know what? I'm going to sell all this junk, even though I was down, and I'm going to go into Palantir. And I had 90% of my portfolio at one point in Palantir. So there are other opportunities in the market. What those are, you know, if you're like, hey, there's a screaming buy versus where you're at with PayPal, it may make sense to you to, you know, think about reallocating. You don't have to hold on just because it's down and you're not break even yet. I mean, like after today, nobody's break even unless you've been in since before 2017. So,
Yeah, and if you held from 2017 until today, then kudos to you. You are one impressive investor. I wish I had the patience and stomach of you. That is some serious dedication.
yeah, it's down now 15%, 44.54 in the pre-market. Yeah, I don't know what more can be said there. I almost don't even want to look at the numbers, but we do want to do that. Let's see.
Neil
Is
is
there
here.
anything looking back through? And you guys, of course, have the slide deck, I'm sure, as well.
Can you add Neil to the
just
call?
Yeah, okay, great, he's here. Perfect. Well,
I need Neil's raw thoughts. He's the last
yeah, let's.
standing hyper bull of this company.
Okay, Neil. Did you
What?
see the results?
I didn't see the results. I just saw 20 messages pop up on my phone, as if I'm the investor relations guy from PayPal, which I guess I am.
Yeah.
I'm actually on my way to PayPal HQ to take over the company.
Yeah, wait. Because you don't know the results and you know the reaction. Can you try to guess?
No, I know that Alex Chris is out.
Yes.
Yeah.
I
What
just
about
don't know all the rest. All the rest I don't know. I just know I got messages. Alex Chris out. At first I thought it's just because the stock is down, but he's literally out of the CEO position. I haven't seen the results. I haven't really. I don't know.
All right.
This is crazy. And honestly, good timing that Robinhood also went down quite a lot yesterday. So might do the old switcheroo here.
Yeah,
SoFi's
that's probably.
looking attractive too. And there's others.
Palantir is looking massively undervalued too. No
Yeah,
joke
so-
on that one.
All right, so yeah, for the result, just a recap. So dollar neutral growth was actually 6%. They were aided by a weak dollar in total payment volume. Revenue, which is what the market more cares about, is 3% dollar neutral, so 4% growth year over year. So pretty terrible. Transaction margin 3%, non-GAAP EPS 3%, adjusted free cash flow actually under where expectations were. Slow activity growth. That's not the most important as far as monthly active and active in quarter four, but 1% is not great. More importantly here, branded, 1%. They somehow managed to do 1% growth for branded in quarter four 2025. If you look at the guidance, slight decline transaction margin dollar, flat transaction margin dollar interest and customer balances, mid-single digit decline non-GAAP EPS, mid-single digit decline GAAP EPS, slight decline for full year 2026 margin, roughly flat transaction margin growth, adjusted free cash flow. I mean, it's still healthy, 6 billion plus, but yeah, the reality is all of this is in decline, and with transitioning to a new CEO, it's like, can you even count? Like, what's the strategy here? We don't know.
Did they give a reason, or we have to wait for the call?
No, they said it's because it's weak results. It says. So I'll give you the direct quote. Our execution has not been where it needs to be, particularly in branded checkout. As announced today, the board's appointment of Enrique Lores, which is the apparently CEO of HP, when I googled that name, is the next president and CEO, and Jamie Miller is the interim CEO.
Yeah.
So the worst case scenario happened is we basically got screwed over and got lied to. In short,
by two CEOs, because Dan, like during Dan Schulman's period, they were already talking about basically Fastlane before it was called Fastlane. They're like, yeah, we have this new guest checkout, like you don't have to enter any of your information. We're working on ads. We have this vault. We're going to leverage the vault. That was during Dan Schulman. Nothing happened then. Then we got Alex Chris. Nothing happened under him, except, PR news wires constantly, but I don't know.
So I mean, I wouldn't say that. Like, basically, like they were resolving a lot of their tech stack issues, which it was a very siloed business that didn't communicate well. The tech stack had been lagged. They had lagged in that investment. They didn't have a cohesive strategy for years. He brought that. Now, execution on what's actually important to investors. So, like, think long term, like he had the right mindset. He had the right ideas and everything. He just didn't have enough time. And with where the stock performance was, and frankly, this execution, not just stock performance, is absolutely dismal for quarter four. So, yeah, I understand why they got rid of him. It's probably a mistake for PayPal, and I don't know if they can ever recover, honestly.
Someone commented, apparently the new CEO was a cost cutter at HP with plenty of layoffs, so he might streamline PayPal. But that is one of the big problems with PayPal. I mean, we just mentioned that they're paying $500 million towards, customer support every year. I think they have something like, what is it, about 30,000 employees? There's no reason that you need 30,000 employees at PayPal. Let me try to see if I can find any news about that.
And also, it doesn't help when you don't, when you say that a product will launch at certain date and you don't do it. The PayPal and Venmo interoperability, it was supposed to go live November 17th. I got the email and it never happened. PayPal World never happened. Well, it hasn't happened just yet. And many other missed opportunities. I use Venmo pretty much daily. Send payments, never got an ad after sending a payment. The PayPal app, the experience, I understand why people, they don't want to use it. And it's been a while, and they've been promising that they'll make all these changes, and they just didn't happen.
It does seem true that he has done some cost cutting in recent times. In
How long has he been
November
there?
at HP.
2 years and
Yeah.
3 months.
Oh, it's
Did
been
they
below
actually buy back more shares this quarter, or that it didn't even happen either?
1.5. 23 million shares.
Yeah, it's
Yeah, Roy. So now we understand why they didn't answer our emails anymore.
Oh,
Makes sense.
Yeah, it seems like after the second quarter results, that's when like the communication strategy completely changed, and I would expect that at that point, maybe the board of directors or somebody had stepped in and said, "Nope, you're not doing this. We need to look at what's going on, and no communication outside of what's already scheduled." So, yeah, makes sense. It is what it is. I'm going to let you guys drive for just a second. I'm going to get the webcast ready to go here, just for when it
It
does
would be
connect.
such a major mistake to like try to pour money on the problem and hope that it resolves it. Now if they just okay, no buybacks, just use all our free cash flow towards growth, perhaps even turn a gap unprofitable during the process, just growth at all costs. That would be a major mistake for the company. But also, like, what was the dividend like last quarter about? Like, it still doesn't make any sense. Was that like some last ditch effort of, okay, I need to make the stock price move? Maybe we'll be included in some dividend indices if we do this. It still doesn't make any sense to me. Yeah, results are out.
Yeah,
it makes zero. It makes the results. I don't know if we can call it results. Absolute. It's a big disappointment because on paper, and even off paper, it is extremely undervalued. But the biggest issue here, just like this is the worst case scenario, is a good company, a cheap company, undervalued company with a lot of potential getting screwed over by bad execution and management, which I guess is what has happened here. And unfortunately, we are, or maybe we were, investors in that company because we got sold a good story, which turned out to be not so great. And it sucks. But
yeah, let's see what they talk about, especially what the analysts ask. I think we can get a lot of information here. So I'm not making any moves until I have some clear. Of course, Crossroads was talking about this for a long time, even prior. He's like, I need to see this or I'm out. Fair enough, but I would advise against making anything rash. Just based on your current feelings. You should probably evaluate properly, and then if you still feel like you want to sell, then that's probably the correct decision for you. But I'm one of those. I need some time to digest properly.
Well, your options, Emir, won't be worth much later today. I can promise you that.
I was just saying, I felt so smart, like selling my $110. I was like, 110, bro, this is free. Sold those at like negative 90%, bought $65 after you and me talked. I'm like, bro, free money. I'm never touching an option in my life again after that.
So they are guiding for 6 billion in repurchases, in share buybacks in 2026. I guess they'll be cutting costs, and that's how they'll make it. But
so
I
Venmo
don't see this playing out very well in 2026.
Where did you see that? Share repurchase 6 billion. Yeah, capex about 1 billion.
So that remains the same. They're just guiding for lower EPS growth.
Yeah. So Venmo 12% growth for the year, FX neutral basis 30% for the quarter. So there is some growth, double-digit growth there. P2P also double digits. Those two together, about 40% of revenues, or a bit more. 40% of TPV. Sorry. And we know that Venmo is not properly monetized. So, Venmo currently 18%. If they can get that to 20, start to monetize that. I mean, there's another proper. If they sold Venmo, it would be worth like, yeah, that's what I'm saying. Like Venmo alone, like the ads platform alone could be worth the whole market cap. That's what we're saying. Like it is cheap, but apparently it is cheap for a reason, because it is deteriorating, in the major.
So there's a few people buying that they're like, hey, cost cutting. It is stupidly cheap right here. It is probably going to be worth more in the future at some point. But at least for me, that's not enough. And to your point, what you said, Amir, like as far as not being rash and doing this on emotion, for me, like going in, I spent a lot of time like, okay, what do I need to see? What do I have to see? What are the situations where if I don't see this, how much would I cut? I went into this kind of expecting not great results, far better than this. And I was like, I might cut half. I still think it's worth my time. This is far worse, and with Alex Chris out as well on top of that, and the guidance for this year just lackluster. I'm like, okay, I've seen enough. This isn't based on emotion. I'm not happy about it. Believe me. I mean, I'm wearing a PayPal shirt of all things, so this one I'm not going to burn either, But no, for me, I'm out completely. But what about you guys? Is there any scenario of what they can say or what they can clarify on the call, which would actually get you to not only not exit but to buy more?
Definitely not buying more. But if the narrative, if this new CEO comes and talks some more about Venmo, ads, not agentic because it's a little bit too early, but all the other initiatives that they have and how they're planning on executing on those, that could change sentiment a little bit and, let the stock not keep falling and finding a floor at like $45, $40, and then it has to be up from there. But this is not a stock that deserves to be trading at $80 or $90, at least not right now, especially if they are telling you that EPS will decline in 2026 or will grow slightly despite $6 billion in buybacks. So,
I mean, yeah, it's a tough one. I mean, we've been well, speaking for me and probably a lot of people in the chat, we've been patient for so long. It would, okay. So let's say that the scenario is like, okay, let's say that I sell out, even though I still believe that it is still undervalued. Last time I checked, in the 60s range, the stock was priced for negative 5% revenue per year for the next 10 years. Negative 5% compounded. They are still not negative, so they are very undervalued. But let's say that I sell out because I'm seeing the deterioration start. Let's say that they actually start to see material stuff within the year and the stock price shoots up. I would probably not be able to forgive myself as an investor, given how long I've already been patient. And as a, valuation-driven investor, yeah, I don't know how to reconcile it. It is tough. Like selling stocks is probably the hardest thing in investing. Like, to be honest, like buying is easy. You can be excited about stuff, but selling stuff it's really difficult for me personally. I'm sure many people share that, but I'm curious about our GOAT couch investor, the hyper bull. Like, what would make you sell?
Yeah,
I mean,
for me, real quick, for me, thesis is broken, and when the thesis breaks, I look for an exit. Sometimes that means, over the next few weeks or months. For me, I'm like, nope. There's screaming buys for me. I'm not going to hold this.
Yeah. So if you do that, you have to tell yourself, no matter if the stock price triples by tomorrow, you have to be like confident in your, like, you can't like go back, oh, I shouldn't have done that. No, you made your decision given, these reasons, and you have to stick by that. Like, don't feel bad if that happens, because that has happened, to me, to others. It's a bad feeling, but as long as the decision was made on solid, grounded, not opinions but facts for yourself, for your investment style, then don't feel bad.
Yeah, I agree. I mean, I agree with Emir, because if, let's say, first of all, I have options, they are probably will not worth much today. I still have shares. The shares I will probably sell, and I think I'll just buy Robinhood today, because if I can get Robinhood at $90 with a company that does execute very, very well, rarely misses a beat, despite, yes, okay, there might be some cyclicality and some headwinds if crypto continues to go down and things like that. But with PayPal itself, let's say I sell today, the new CEO comes in. With new CEOs coming in, I mean, they're always putting the bar very, very low. I don't know, people in the chat probably know the CEO much better than me. I haven't looked him up, but apparently he did do some good things at HP. So I assume he comes in, look, this is the guidance that we give at the start of the year. Should be easy for us to deliver those results and probably exceed them. Because I don't want to have, again, because Alex Riss came in, he put the bar very low, never really exceeded them by a lot. It was every time, a slight bit here, a slight bit there. We'll see what happens. Selling today could probably mean you sell the bottom, but as people said in the chat, there are probably better companies right now, especially since, yes, the thesis did change. I mean, Alex Riss is out. I think, Roy, you and I, the reason why we actually bought PayPal to start with is because we like what Alex Riss said at the start of his reign. So it has completely changed. I have no issues admitting that I was wrong here, but I was wrong because I was told not the full story by the company, which sucks, because you lose money, you lose time. There are clearly opportunity cost here. So yeah, my shares will probably go to Robinhood shares, and the options, we'll see what I do with those later today.
Yeah, these words. He did shock us. They did shock us. Absolutely. This is a shocking quarter. So, man of his word. No, just all jokes aside, I wish Alex Chris well. These sort of things happen. It's painful as an investor. Yeah. How has PayPal not performed any layoffs? They didn't this last year, at least not very meaningful ones. They did announce actually but it wasn't broadcast loudly on a 10Q that they were basically over the next couple of years right sizing. That's probably done more aggressively under the new CEO, and I think it's probably warranted. I mean, especially with results like this.
So let me ask you guys this. What do you think went wrong with Alex Chris? Did he underestimate what he was going to find at PayPal? Did he focus on the wrong areas? Focus too much on, let's say, Venmo, which is, yes, it's growing well, but it's not going to move the needle in such a big company? Or what do you think that he should have done better? More layoffs? How do you guys think about it?
I mean, let's go to the extreme case scenario real quick. Let's say Elon Musk took over. On day one, I think half the company would have been gone. Half the employees would have been gone, and then they would have, or maybe even more, and then along the way they would have added where necessary. I think Alex Riss, the vision was a good vision coming in. Many things actually are going in the right direction, but he was just not aggressive enough. Maybe it's not his fault, maybe it's the team, but then again, he's the reason why the executive team there exists today. I think he was maybe too nice of a CEO. Not a killer CEO. He could have laid off quite a lot. I mean, we talk about customer service. How many employees do you need at PayPal today? Not that many, especially not in this day and age with AI. And it's not like the customer service at PayPal is a good one either. So I think the vision was fine, just he was not aggressive enough. And I guess the team around him was maybe not the team to turn this ship around. So hopefully the new guy is a bit more aggressive, which, based on chat's comment, I guess he is.
Yeah, I think, I mean, like, I think you hit the nail on the head. I'll take it, maybe like a little bit different direction. So Alex admitted as much that when he got in, that PayPal was far worse off as a organization than he anticipated. That's not great, but the reality is it's not something that isn't. You can still do something with it. It takes time. And with an organization as old and as fractured as PayPal was under Dan Schulman, ultimately it's really difficult work. And so he needed to be more aggressive on the front end. And the other thing too is like he came from Intuit, where he was head of the small and mid-sized business, ran like half of Intuit. But the thing is, with his position, while he would be in the public like a Diego Scotti is at PayPal, he's not like seen as a CEO. So like the results of what's happening there, like shareholders are not like screaming for his head if the stock goes down like $10 at Intuit, versus here, people are frustrated, insiders are frustrated, people that work at PayPal are frustrated as well. And I think that he probably also underappreciated not only how much time it would take to turn this thing around, because it was a far worse organization than anyone expected until he really shone some light in some of those details there, but also that he didn't have as much time as perhaps he was thinking to turn things around, simply because at Intuit, if he was where he was like in PayPal, like a Diego Scotti, he might have like 5 years. CEO, nope, you've got a couple of years, and if it's not turned around, this is very common. What are you guys' takes?
Yeah, I would agree that he seems more suitable to be more of like a steward than, sheer execution. But, I don't know if it's true that he's not a killer at all. I mean, we have to remember he came in, he replaced the whole executive team more or less. Not that we've seen any positive results from that. Probably should I, address the meat overall. But if you're asking me what he did wrong, I have to say that I was very aligned with the overall strategic vision of Alex, Chris, and PayPal as a whole. I mean, agentic commerce is the future. They were positioning themselves for that. They adopted, stable coins to cut costs and make the business more efficient. They did that. That's also the future. They were working on, fixing conversion rates. The typical pain points of commerce as it is today. Like they were doing a lot of good stuff. As you mentioned, the business as a whole was fractured. Like the Venmo team did not even communicate with the PayPal team, trying to build those two together and try to actually monetize Venmo. So like all of these strategies, the ads platform, I can get aligned behind all of those. Like the strategies are sound, but the execution was not there. Why is that? Because we never really got commentary, explicitly saying, okay, here was the timeline we laid out. We did not meet them. Here are the reasons, and here is what we're going to do about it. Like we just got, this, as I mentioned before, we got like PR news wires about partnerships, but no real like actual commentary on what's going on. So there was this veil of the management team is transparent with us, because seemingly they're sharing a lot, but we actually don't know any of the details, and we still don't know about them. So I'm not sure what went wrong, because I mean he cleaned house on the executive level. The strategic vision was there, but nothing happened. I would be surprised if they completely turn around and change everything that they laid out just because they got a new CEO now. I would be very, very surprised if they're like, yeah, all of these like growth trajectories that we laid out for ourselves, we're gonna abandon those. Here's what we're gonna do instead. I think those are still like worth executing on. But yeah, it's gonna be a good call. It's gonna be an interesting call. See what happens.
Yeah, if Jamie Miller is the driver of the call, that's not her strength. So, but the one thing I'll say is Jamie and also Alex, but he will not be on the call. They do speak very candidly when things are not right. I think too much, but I mean, not today. Like as somebody who's now on the outside looking in, I do have some options, and yeah, to your guys' point, like those are so far down, not worth much. I might just keep those as is. But that was a very small part of my position at PayPal anyway. So painful. Juan?
Now I'm reading that Enrique, the new CEO, he's been at HP for 25 years, and they're planning to eliminate 4,000 to 6,000 jobs through 2028, and they are planning on saving $1 billion by 2028 from, you know, savings that will generate. So yes, I think his strategy was good. Alex Chris's strategy execution could have been better, but he was just not aggressive enough. And as Emir said, they're not going to get rid of the plan that they had because they're focusing on the right areas, agentic, ads, you name it. But I think he joins a company that's in a better position than it was in 2021, 2022, well, 2023 when Alex Chris joined. We'll see how he approaches it.
That was a good highlighted comment. Still sad that we have to put our hopes on firing employees in order for the share price to move upwards.
Yeah,
Man.
it's not the best. And I, you know, I've had that before happen. This is a long time ago, but in the great financial crisis, ended up we were affected by layoffs in the company that I was at. But it's, you know, my heart goes out to anybody that's impacted by that. Now, as far as the downsizing, I would have to look back, but they had already projected to do some of this anyway in 2028. I think that's roughly maybe double the number, which is still, they still have a lot of employees with that count. So it'd be interesting to see if they even downsize further than that or what the strategy is here. So,
I mean, PSP growth is accelerated. If we want to talk about some positive things here on the stream,
PSP, bro.
What is it? Acceleration from 6 to 8% growth. There are some positives in this report. If you look at the quarter, there are some positives for the quarter. It's just that guidance is definitely abysmal. And plus, yeah, we have a new CEO coming in. But yeah, if they continue with the same, let's say, direction, but be a bit more aggressive, then I think the guidance can easily be beat. But yeah, I guess we'll have to wait a little bit until we hear something on the earnings call. But
so PSP on the quarterly, it looks like an acceleration. But if you compare fiscal year 24 and 25, you went from 15% to 5% for the year, and that's also the lowest margin segment as well. That's the
but margins have improved.
Right here. Yeah, margins have improved, and that was part of their strategy. Is they were changing trading volume for higher margin, and we're seeing them come out the other side. So this absolutely will be higher, like barring something next year. But yeah, that's
but wait. Let's talk about that. What does that look like in reality? Because you have the merchants you have, so you're basically alienating merchants. You are making merchants that you already have choose a competitor like Stripe, because it will be cheaper, because you believe that you can provide value-added services, that you are intentionally raising prices to lose customers. That means you don't have pricing power. You're basically forcing them to choose Stripe instead of you. So materially, what's the... I don't get it.
So under Dan Schulman, Braintree, which is their payment service provider, was basically engaging in a race to the bottom. And they talked about how valuable the service was, but relative to the Adyens and the Stripes of the world, not so much. They were found to be valuable just because they were cheap, which is not enough. And so there have been improvements, meaningful improvements, in fact, in Braintree. It's been more competitive as a product. And they realize, like, hey, this race to the bottom, it's going to, hurt everybody. So let's not do that. And so they're pivoted away from that. Now, with large enterprises, which is, I think, where the conversation is, that's what Braintree does for the most part. It's a white label payment service providing service. They always use an orchestration anyway between several different payment service providers. So if they're using like PayPal, like for 30% of their transactions, or Braintree rather, that would be a shift of like 20% for higher revenue. But for certain users, basically in-house in a organization, they're like, okay, even though it's a higher amount than we've been used to paying, we're willing to do that because it really works well with this customer base. So that's essentially what they did. That's already done. That's in the past. but did cause some headwinds on revenue. And of course, especially in a bull market, that revenue, that top line number is very important. This is frankly absolutely dismal. But yeah, payment service is reaccelerating. It's just not enough for me.
But you know, I'm all for exiting the race to the bottom, but you have to provide value for raising prices. And it's not like take rate is starting to accelerate. It's take rate is still down. Transaction take rate is up 0.01%, you know, quarter over quarter, but year over year is down still massively. So I'm questioning, like, okay, where did we exit this race to the bottom? Because it doesn't look like it.
What was the OVAS number for the quarter? Did that increase?
Let's see.
You don't want to know that, Neil. 875, I think. 10% year over year growth.
Yeah,
Throw up the screen.
857.
Yeah.
10% year over year.
Yeah. So.
But yeah, I mean, the take rate is not going up. Transaction take rate stalled for 1 quarter, but overall down as well. And you sacrificed seemingly a lot of payment volume for that, because even like in an orchestration, let's say that you have, you know, an orchestration between Stripe, PayPal, Adyen, whatever else there is. I'm guessing that you just have the options available. So I don't know how it works, like how you direct. Maybe I would have to look into that. But I mean, I'm not seeing the expected results. Sure, transaction margin dollars are like growing barely, but I mean, they could have done that even with, you know, not sacrifice. I don't know what they did materially. That's what I'm trying to get at.
Yeah. Transactions per account also slid, not in addition to the basket size that they were talking about earlier too. It's tough. It's kind of like the opposite of like the Palantir quarter and the SoFi quarter, where in those you almost have to hunt for bearish things. Here you have to hunt for bullish things, and boy.
Yeah, I came up with the Palantir high this morning in Japan. And I'm like, I'm like, yeah, okay, let's cover this. But you know, it is crazy. Still, okay. I'm just pointing stuff out. I'm not like overly bearish or bullish. I'm just trying to look at this. Number of payment transactions for Q4 was 6.7 billion. Q4. This is the holiday season. The quarter prior was 6.3 billion. So basically, the holiday season like gave them more or less nothing. Like the holiday season is like, oh my God, PayPal is gonna print. You know, didn't really get that.
Which it sounded like it when they didn't announce anything after Black Friday and Cyber Monday. They just said double-digit growth or something like that, and they didn't give any specific numbers, specific figures. So in that moment, you would start to think that something was wrong with, you know, the type of growth that they were putting up. One good thing that I'm seeing here is that stock-based compensation went down 16% year over year. At least that's something good, and I'm sure it'll go down when this new guy takes over.
Maybe, yeah. Well, so one of the factors of stock-based compensation, I was fine with it. They're bringing in, and I actually think that they brought in a lot of really excellent people. But when you do that, there is stock-based compensation. The buybacks more than offset that, but execution lag. Yeah, the earnings call looks like it'll start here in about 6 minutes, guys. Anything else stand out to you for your quarter, for the quarter, or any other thoughts on PayPal?
I mean, I guess now when we look back and they said weak consumer spending, and all the other companies have banks and Jerome Powell and Shopify, etc., and they said consumer seems quite okay. Well, I guess that was the truth, that PayPal specifically saw weak consumer because the results show now that it might be a PayPal specific issue here, just like Amir just said. The holiday season barely helped them, which again, it's very surprising, especially. And I highly suggest everyone to follow Roy, Amir, and Juan here, especially if you want to learn more about the Venmo and the advertising business, because ads, based on the comments, should be doing well. It's probably one of the best thing here that they can talk about is the advertising business. I don't know if we'll hear more about that during the call, maybe not, but when ads, Venmo, buy now, pay later seem to be doing well. Just for the overall business, the effect is not reflected just yet. I'm very curious what this new CEO is going to do. We'll see.
I've said it many times, and I'll say it again. The Venmo push has to be even bigger. They have this huge amount of colleges and college kids that you could get them to get the college card. They said they added about a 1 million of those during Q3. They need to get more partnerships with more conferences. You have the SEC conference, which has the biggest football teams in the nation, and the ACC conference here, in the South. So they need to push even further and grow Venmo even more, because that's one of the very, very few positives that they can talk about. So might as well just keep pushing there.
So yeah, on this question, it goes back to what Amir and I were talking about too initially, that too many, I mean, press releases are great. I'm not criticizing that, but too many press releases relative to actual performance. And a lot of them, like the Google partnership, like the OpenAI partnership on agentic commerce, good. And agentic commerce may be here sooner than we expect, but still, it's not going to be a meaningful revenue driver for 2, 3, 4 years. They need something earlier. Venmo was hopefully going to be that in advertising as well. Not a single mention in the slide deck of advertising. Surprise, surprise. That was another thing that before I sold my shares, I'm like, okay, let me just see. Nope, nothing there. All right. Not great. And it wouldn't shock me in the earnings call if they don't even mention Fastlane or advertising at all. They should, but man, that lack of clarity is tough. So it's not enough to just have a partnership where it's like, hey, this might be a good thing in a few years. They have a lot of those. Earnings call looks like it'll start here in about 3 minutes, guys.
I do wonder what analysts are going to ask in this call. This is like, because I mean, with Palantir, Amir, you know it. I mean, we all know it, right? With Palantir, what do we have? Two analysts and a half or something? With PayPal, at least there's going to be like a barrage of questions. I have one question, and then it's one question with 3 questions within it. I'm very excited for this call. I mean, jokes aside, being down another 15% at this valuation is insane. Like, it's like literally the market is like, screw this thing, take it down to 0. Amir, you can update your spreadsheet now, because in 3 years this company is going to be private with the amount of buybacks that they can still do, and if the market cap becomes smaller and smaller. But being down 15%, you would think that this is a company that is on the decline and trading at 30 times earning or something. But yes, low can go lower and cheap can become cheaper.
Well, let me see here. What's the market cap now?
Market cap now is 39 billion if it opens at $44. So that's 6 years of buybacks.
Yeah, I mean, as long as cash flow generation isn't like getting destroyed, I still have some hope. But yeah, I'm not expecting much. Okay, let me see here. Let's assume the stock price is 44 right now, right? Cash flow margins, let's say that they actually take a hit. Let's say something like 14% free cash flow to the firm. They did 16 in 2025. I didn't calculate for 2025. I don't think it declined a lot. Like, they would have to decline 8% every year in revenue. So they did 32 billion in 2024. They would have to do $13 billion in revenue by 2034 to be worth $44. Like they would have to more than half, like lose half their revenues by 2034 to be worth like where they're trading. So but the thing is, everyone already knows that it is cheap, it is undervalued. I don't think like that has been the case for like since the 80s. Like everyone knows it. Like I don't think that's gonna be some kind of bounce off of that. We need some tangible results to like, we need some sort of catalyst, I think, for the stock price to actually move meaningfully, you know, upwards. But yeah, I mean, it started. Do you have it, Crossroads?
Maybe the music.
I don't hear it yet. Has it started
Let's
for you guys?
run a poll. Does the stock recover today or not?
All I'm gonna say is that we've seen them beating over and over again, and the stock kept going down. All I'm gonna say is that I wouldn't be surprised if this is the bottom. The $44 range, it's the lowest level since 2016, October 2016.
You know what's crazy? This CEO could actually be what the company needs, and now actually the thesis starts to play out for real. Maybe.
The things we tell, the things we tell ourselves.
But if he cut costs and
some folks are saying Jamie's talking. It's for whatever reason Q4 is not. There's no volume. Let me share this just in case. If you guys can hear it, great. I do see that it's live. Well, let me share the tab.
Why don't you just do YouTube like Palantir? Oh, I need to register a Q4 account? Oh, continue without.
Yeah, I can just do guest stuff.
Let me do this. Sorry, guys. We're just a bit behind.
Yeah, she's talking.
Okay. Yeah, if one of you guys don't mind just sharing it. I don't know, for whatever reason, the volume is not showing up on my end.
Let me see. Share screen.
Yeah, share tab specifically. I don't know. Comet browser does not like it, apparently.
Present. Share tab.
Okay, and then
multiple dimensions, and I'm confident about our path forward. Last February, we held an investor day outlining our transformation strategy. 1 year later, there are elements working very well, but there are also areas pacing below our expectations, primarily within branded checkout, which I will spend much of my time discussing today. First, let me address the areas performing well. In 2025, Venmo revenue grew approximately 20% to $1.7 billion, excluding interest income. Total active accounts surpassed 100 million, accompanied by 14% growth in ARPA for our monthly actives. We've turned around our enterprise payments business, delivering 7 consecutive quarters of profitable growth and a return to double-digit volume growth in the fourth quarter. These two businesses were once small contributors to profitability. In 2025, they drove nearly half of our 6% transaction margin dollar growth. In Buy Now, Pay Later, we delivered over $40 billion in TPV in 2025, growing more than 20% year over year. Additionally, we've made progress building new long-term growth drivers, omnichannel, agentic commerce, crypto, and wallet interoperability. Where we haven't made the same progress is in online branded checkout. We've reimagined a product that had been stagnant and underinvested in for years, creating a new value proposition for merchants and consumers. But we were too optimistic about how quickly we could drive change and customer adoption across a massive global user base. The results are not yet where we expected them or want them to be. Let me update you on where we are, what is working, and the steps we're taking to get back on track. For the past few years, we have delivered consistent mid-single-digit TPV growth. However, in the fourth quarter, online branded checkout TPV grew 1% on a currency-neutral basis, down from 5% in the third quarter. The 4-point deceleration was more than we expected and was concentrated in 3 main areas, each contributing roughly a point or so to the slowdown. First, U.S. retail weakness. We saw pressure across our retail merchant portfolio, particularly among lower and middle income consumers. While part of this can be attributed to macro factors and a K-shaped economy, it's also clear that we need to do more to win with key merchants, particularly during high volume shopping periods. Second, international headwinds, particularly in Germany, which is one of our largest markets. Our German growth has moderated due to macroeconomic softness, normalization of our long-standing market leadership position, and competition from alternative payment methods. Third, deceleration in several high-growth verticals, specifically in travel, ticketing, crypto, and gaming, categories that had strong growth in the fourth quarter of 24 and continuing through much of 25. Cutting across all of these, we had operational and deployment issues that amplified the pressure. To date, our delivery process has started with building a better product and expecting merchants to adopt at scale because of conversion benefits. The reality is our merchants, especially the largest ones, have many competing priorities and require much more hands-on integration support than we anticipated, which has slowed our progress. Additionally, the combination of biometric adoption and competitive presentment have proven critical to branded checkout performance. So while challenges in the macro environment are real, we haven't executed as well as we need to, and our product deployment in the second half of the year was slower than we planned. Our analysis of our merchant base, competitive dynamics, and where we are seeing the strongest traction has sharpened our view of resource allocation for 2026. This work in branded checkout has brought 3 priorities into clear focus: experience, presentment, and selection. These are the areas where we see the greatest opportunity to restore momentum. We know that consumers engage more deeply and frequently when they have a frictionless experience. They choose us more often when our products are featured upstream at the point of purchase, and they habituate when rewarded through loyalty, marketing, and other programs. On experience, our focus needs to be on both ensuring a frictionless consumer experience through biometric and passkey adoption, and that merchants have upgraded to our target experiences. On presentment, we need competitive placement, including upstream buy now, pay later messaging and second buttons. And on selection, we must deliver loyalty benefits using rewards and co-marketing agreements with compelling consumer incentives. On experience, we've created a great product experience that performs well across desktop and mobile. When a consumer vaults PayPal as their default payment method, it's seamless. No password or authentication is required. The wallet typically has multiple funding sources ready, and we deliver 95% or greater conversion on average, which is second to none and a foundational strength we are building upon. We need to make vaulting available with more merchants and take friction out of the initial sign-up and one-time checkout flow. For non-vaulted transactions, we're continuing to scale our redesigned paysheet experience globally, now covering more than 30% of global checkout transactions. Fully optimized cohorts show nearly 1-point conversion improvement, though adoption across our backbook remains incomplete, with the target experience implemented on only a subset of our global transactions. 2026 will be about continuing to scale with strategic merchants and partners at the same time that we drive biometric enrollment. As discussed before, biometric authentication amplifies the impact of our pay sheet redesign and makes vaulted sign-up easier, driving 2 to 5 points of conversion improvement in testing with some of our largest and most complex merchants. On presentment, we're making good progress, including adding upstream BNPL messaging at more major merchants in the fourth quarter. When PayPal is positioned above competitors and the value prop is amplified with either co-marketing or pay later messaging, we see more than twice the selection rate compared to when we're positioned below. On selection, over the past 2 years, we've built a more compelling value proposition for consumers. That includes launching new products like our debit card and expanding options such as buy now, pay later, repositioning PayPal as an obvious choice for everyday purchases, whether paying now or over time. The result is a more engaged and healthier consumer base. Power users, which are consumer accounts that transact more than 100 times per year, grew 5% year over year. PayPal mobile app use among online branded checkout users has increased from approximately 50% in January 2023 to more than 60% now, and we will drive that even higher by year end. Consumers with recent app use are about 40% more likely to select PayPal during checkout the following week, underscoring the value of app engagement in shaping checkout preference. This approach delivers when fully deployed. When we look at Cyber 5 performance across multiple merchants, including in retail, tech, and entertainment, for those with our latest checkout experience, strong presentment, upstream BNPL messaging, and co-branded marketing with attractive offers, PayPal performed well. On average, those merchants delivered very attractive double-digit branded TPV growth, significantly outpacing their local markets. That gives us confidence that we have the right playbook. It's just not deployed in enough of the right places. Over the past several months, we've realigned our checkout teams with full ownership and improved operating rhythms to speed decision-making and execution. 2 themes will shape our efforts in 2026: focus and investment. This is one area where Enrique will really help. His track record of relentless, disciplined execution and performance improvement in complex business environments makes him ideally suited for this challenge. First, a relentless focus on the highest impact merchants. To date, we've been optimizing for every merchant, and that approach has slowed our ability to move quickly on what matters most. We're changing our approach to focus on strategic merchants, representing nearly 25% of our branded checkout volume today, but could be much larger. In January, we formed dedicated teams to implement improvements across experience, presentment, and selection for these merchants. Second, focus on implementing experience and biometrics together, not sequentially. In too many cases, we were deploying our redesigned checkout without biometric enablement, which does not deliver the full conversion lift we know we can provide. That's changing. We're now deploying experience and biometrics together as a package more consistently. When we integrate a merchant onto our latest experience, we will simultaneously run biometric adoption campaigns targeting their consumer base. We made good progress in 2025, but there is more work to be done. About 36% of our consumers are now what we would consider checkout ready, which means they have biometric authentication in our app or with a device passkey. This is a 15 percentage point improvement relative to the prior year, and our goal is to bring closer to half of our consumers to checkout ready status by the end of 2026. Third is a focus on presentment. It is just as critical as experience. As I mentioned before, when we secure competitive placement on a merchant site, we perform significantly better. It is early days in bringing BNPL messaging onto product pages, now visible to less than 15% of our traffic, but the data is convincing. When our buy now, pay later offerings are presented upstream and with a second payment button, we see more than a 10% lift in branded checkout volume. We don't yet have enough of these high-impact placements in market, which was amplified during the holiday shopping season. And that's front and center as we focus on branded checkout execution. In many cases, we're tying our economics directly to performance so merchants share in the upside. Fourth, a focus on giving consumers a reason to come back. Our checkout improvements help with conversion, but we can do more to drive repeat usage by combining rewards, buy now, pay later, and app-led engagement to make PayPal the obvious choice for consumers time after time. PayPal Plus, our rewards program launching in Europe and in the US in 26, enables consumers to earn and redeem rewards at checkout, creating the consumer flywheel we've been working to build. We're seeing early but still encouraging results from the UK launch late last year. In December, branded checkout TPV rose by mid-single digits year over year for UK users enrolled in PayPal Plus, and their overall PayPal TPV increased year over year compared to non-enrolled users. This was achieved almost entirely organically before activating marketing, which speaks to the opportunity ahead. In parallel, we're launching a brand new app this year, which will be a destination for buy now, pay later management, rewards tracking through PayPal Plus, and personalized offers, all designed to drive app engagement, which leads to a better checkout experience. From an investment perspective for branded checkout, we're striking calculated deals with strategic merchants that create value for both sides. Our approach helps them tackle their greatest needs, whether that's improving conversion, lowering payment costs, acquiring new customers, or co-developing solutions, while simultaneously modernizing PayPal's experience and strengthening our presentment across their channels. These are important investments to make. When more flagship merchants are live with full experience, benefits cascade. We accelerate learnings, refine our go-to-market, and unlock the brand halo effect from being optimized at scale on merchants consumers use most. Overall, we're focused on execution as we move through 2026. As our redesigned experiences scale, biometric adoption increases, presentment improves, and our rewards program and app drive the flywheel. We expect these initiatives to deliver improving results daily, weekly, monthly, and build over time as they reach scale and produce measurable impact. I'll now briefly cover the progress on our other growth drivers where we are seeing strong success: scaling Omni, growing Venmo, driving PSP profitability, and scaling our next-gen growth vectors. Despite online branded checkout challenges, branded experiences TPV grew 4% in the fourth quarter. We're live with debit or tap to pay in the US, Germany, and in the UK with positive initial results. Starting with the US, where the PayPal debit card was launched over a year ago, in the fourth quarter, TPV growth accelerated to over 50%, and MAAs grew by over 35%. We're happy with this performance and learning from and scaling what worked in the US to Germany and the UK, where we now have more than 700,000 debit card MAAs combined. This includes unique reward offers, marketing investment, in-app prompts, and making it easy to add the cards to mobile wallets. We're pleased with the initial progress of our Omni initiative and see a clear path to extending that success as we move through 2026. 2025 was a breakthrough year for Venmo, evolving from peer-to-peer payments into a monetized commerce platform. We reached over 100 million active accounts, and the progress is showing in our results. Venmo TPV grew 13% in the fourth quarter, and monthly active accounts reached 67 million, up 7% year over year. Venmo debit card TPV was up over 50%, and MAAs grew 50%. Pay with Venmo TPV was up 32%, and MAAs are up 26%. Venmo revenue grew approximately 20% year over year to $1.7 billion in 2025. More importantly, revenue composition has shifted as more consumers are using Venmo for everyday commerce. Over the past 2 years, Pay with Venmo and Venmo debit card revenue has doubled. This mix shift is important to our overall transformation and positions Venmo for stronger profitability as we continue to grow. Turning to our PSP business, in the fourth quarter, we continue to build on positive momentum in our PSP business. Within enterprise payments, thanks to both progress on price to value and value-added services, we meaningfully expanded margins year over year, roughly doubling our net processing yield and significantly improving profitability. At the beginning of 2024, we had several value-added services, but didn't consistently charge for them. We exited 2025 with 16 services that merchants are happy to pay for because they're designed to improve authorization performance or reduce costs. Value-added services adoption continued to scale through the year, and in the fourth quarter, we added incremental capabilities, including Flex Factor and authorization enhancement delivered through our open architecture partner ecosystem, as well as Visa's pre-dispute resolution service through Verify, which will help to reduce merchant costs. We took our first omni-channel enterprise merchant live through Verifone, expanding to in-store payments where 80% of payments occur, qualifying us for RFPs requiring both online and in-store capabilities. Going forward, because of our relationship with Verifone, we can compete for those opportunities and grow our share of both online and in-store volume. This is the realization of the vision we presented at Investor Day last year, and we expect to add new merchants and expand volumes with our existing ones as a result. Let me quickly share some of our latest developments in agentic commerce. Our vision is to create a universally trusted catalog that AI agents can access, discover, and transact with safely and securely. Through our Store Sync offering, we are already connecting early adopters like Abercrombie & Fitch, Fabletics, PacSun, and Wayfair with agentic chat platforms to allow consumers to discover, evaluate, and purchase items within the chat. We went live with agentic purchasing through Perplexity ahead of Thanksgiving, and we are now also live on Microsoft Copilot. We are helping merchants connect with customers through new channels and remove friction from the checkout process. Store Sync is enabled through a partnership with Symbio, which we have agreed to acquire to bring this technology in-house. Agentic won't materially impact 2026 growth, but as AI-powered shopping scales, our aim is to become the default payment option. This is only the beginning, and we are collaborating closely with the major AI platforms as we build agentic commerce capabilities together. Before passing to Steve, let me address the Investor Day outlook provided a year ago. The environment has proven more demanding than we anticipated, presenting both challenges and opportunities. E-commerce growth has been challenging in key verticals and markets, competitive intensity has increased, and merchant adoption has been more complicated to implement than we anticipated, and our execution is not yet where it needs to be. While we're addressing those challenges, other parts of the business are delivering. Venmo is on track to exceed $2 billion in revenue ahead of plan. Our enterprise payments business returned to double-digit volume growth in the fourth quarter, and Buy Now, Pay Later continues to grow rapidly. And entirely new channels like agentic commerce have emerged faster than anyone expected a year ago. For branded checkout, our focus is on narrowing the gap with the market over time. Following our fourth quarter performance, we need to prove that out in coming quarters and years. There are multiple ways for us to deliver profitable growth over the long term, and 2025 was a great example of that. But given everything I've outlined, we are no longer committing to the specific outlook for 2027 we laid out at Investor Day last year. For these reasons, we think it's prudent for now to provide financial guidance 1 year at a time. And Steve will speak in more detail about how we're thinking about 2026 as a starting point. The strategy I outlined today focuses on 3 fundamentals: experience, presentment, and selection. And these critical changes to our go-to-market approach will lay the groundwork for a stronger, more competitive online branded checkout business over time. In closing, while we're not satisfied with our online branded checkout performance today, we are confident in the plan to stabilize and strengthen it. Importantly, we are executing with multiple competitive advantages. Our scale, our trusted brand, deep consumer and merchant relationships, and diversified growth drivers give us resilience and flexibility moving forward. As we continue transforming into a commerce platform, our focus remains clear: drive innovation that scales, deepen engagement on both sides of our network, strengthen and unify our core infrastructure, and deliver sustainable, profitable growth. As Enrique steps into the CEO role, he will bring additional operational focus and discipline to priorities underway. And together with the right assets, strategy, and team in place, we believe PayPal is well positioned for 2026 and beyond. Steve, over to you.
Thanks, Jamie. Moving to slide 9, TM dollars excluding interest grew 4% in the fourth quarter. The drivers of that growth were broad-based, led by strong credit performance, PSP profitability, Venmo monetization, and loss improvement across multiple products. This diversification was key in offsetting the headwinds to branded checkout that Jamie walked through. As a result, we delivered 6% TM dollar growth and 14% non-GAAP EPS growth for 2025. And we continue to have clear opportunities to drive durable, profitable growth in the years ahead. Moving to the fourth quarter and full year financials in more detail, total payment volume grew 9% spot, 6% currency neutral in 4Q, and 7% and 6% respectively for the full year, reaching $1.8 trillion. 4Q revenue grew 4% on a spot and 3% on a currency neutral basis. Full year revenue grew 4% on a spot and currency neutral basis to $33.2 billion. Non-GAAP earnings per share increased 3% to $1.23 and 14% for the full year to $5.31. Compared to our fourth quarter guidance, non-GAAP EPS came in 4 cents below the low end of our range. This was driven largely by a higher than expected tax rate and slightly lower than expected non-GAAP operating income, resulting from pressure on branded and the timing of OpEx. Adjusted free cash flow, which excludes the timing impact from the origination and sales of pay later receivables, was $2.1 billion and $6.4 billion for the full year. Turning to slide 10, we continue to drive deeper, more active relationships with our customers. Monthly active accounts increased 1% to 231 million. Transactions per active account, excluding PSP, which is a good proxy for engagement, maintained momentum with 5% growth. Moving to slide 11, total payment volume in the fourth quarter grew 9% at spot and 6% on a currency neutral basis to $475 billion. Working our way down the page, branded experiences TPV, which includes online checkout, PayPal and Venmo debit, as well as tap to pay, grew 4% in the fourth quarter and 6% for the full year. While debit card and tap to pay spend represent a small portion of branded experiences volume today, they continue to grow rapidly, up 60% year over year. Venmo TPV increased 13%, marking the 5th consecutive quarter of double-digit growth. On an online-only branded checkout basis, volume grew 1% on a currency-neutral basis, impacted by the factors that Jamie discussed in depth earlier. I'll talk more about how we are planning for the current year shortly. Pay with Venmo and Buy Now, Pay Later continue to outpace the market, taking share from other payment methods and growing 32% and 23% respectively. P2P and other consumer volume accelerated to 10% growth in the fourth quarter, reflecting the debit card and Venmo momentum I just mentioned. Turning to PSP, volume growth accelerated to 8% from 6% in 3Q and 2% in the first half of the year. Within PSP, enterprise payments showed notable strength, with volume growth accelerating to 12% due to a combination of growth in profitable front book business and high retention and growth alongside our existing merchant base. Driving higher attachment of value-added services will be a key focus as we move through 2026. Moving to more financial detail on slide 12. Transaction revenue grew 3% on a spot basis to $7.8 billion and grew 3% for the full year to $29.8 billion. Other value-added services revenue grew 10% to $857 million and 14% for the full year to $3.4 billion, driven by strong contribution from merchant and consumer credit, partially offset by lower interest rates. Transaction take rate declined by 9 basis points to 1.65%. Excluding the impact of foreign exchange hedges, transaction take rate declined about 7 basis points. This output was driven by a combination of higher growth in enterprise payments, Venmo, and debit card adoption, as well as branded co-marketing investments. TM dollars ex interest grew 4% in the quarter and 6% for the full year. Growth was led by contribution from our credit and Omni initiatives, improvements in PSP profitability, and Venmo monetization. Branded checkout flow-through was relatively neutral in the quarter, given the combination of lower volume growth and increased investment intended to drive engagement, habituation, and incrementality over time. Within volume-based expenses, transaction loss as a percentage of TPV improved to 6 basis points, a notable improvement compared to an average of 8 basis points during the first 3 quarters of the year. This outcome is a testament to our team's ongoing work to continue to improve and strengthen onboarding, fraud prevention, and risk management capabilities. Non-transaction related OpEx increased 2% in the quarter as we continue to actively manage our cost structure while reinvesting in key growth initiatives. Non-GAAP operating income grew 3% in the quarter to $1.6 billion and 9% for the full year to $6.4 billion. Moving to capital allocation. In the fourth quarter, we completed $1.5 billion in share repurchases, bringing full year repurchases to a total of $6 billion. We also paid the company's first quarterly dividend of 14 cents per share. We ended the quarter with $14.8 billion in cash equivalents, and investments, and $11.6 billion in debt. Moving to guidance on slide 13 for 1Q and full year 2026. Let me start by walking you through some key assumptions. As we discussed last quarter and Jamie detailed earlier, we see a significant opportunity to drive consumer engagement, habituation, and higher selection of PayPal through targeted investments across the portfolio. For 2026, we expect these targeted growth investments to represent approximately 3 points of headwind to TM dollar growth, while driving durable long-term benefits in the years ahead. This spend encompasses the strategic priorities Jamie outlined: scaling new experiences, improving presentment, increasing consumer selection, as well as driving adoption of new channels. About 2/3 of the spend is targeted directly towards branded checkout and buy now, pay later, with the remainder allocated to areas including Venmo, loyalty, and agentic. What's important to call out here is our approach. While a portion of these investments result in lower upfront economics that will weigh on TM dollar and EPS growth in 2026, they are critical to fundamentally shifting our branded checkout product and positioning over the next few years, and have attractive multi-year payoffs that will improve the durability of our business in the years ahead. We're being very disciplined about how and where we deploy capital and will adjust as necessary, leaving flexibility to lean into areas that are working. We're actively harvesting productivity across the organization and reallocating resources to the highest return opportunities. We have conviction in the impact these initiatives will drive. However, given the slower exit rate from 4Q and the time required to scale these programs, our guidance reflects slightly positive to low single-digit branded checkout growth for the full year as we rebuild the momentum Jamie mentioned. Turning to more specifics, for the first quarter, we expect low single-digit revenue growth on a currency-neutral basis. TM dollars to decline slightly, or roughly flat, excluding interest on customer balances. Mid-single-digit growth in non-transaction operating expenses and non-GAAP EPS to be down mid-single digits. For the full year, we expect TM dollars to decline slightly, or roughly flat, excluding interest on customer balances. Approximately 3% growth in non-transaction operating expenses and non-GAAP EPS ranging from down low single digits to slightly positive. Our guidance assumes approximately $6 billion in share repurchases and at least $6 billion of adjusted free cash flow. As Jamie discussed, we are no longer providing the specific multi-year growth outlook we presented at our Investor Day a year ago. As it relates to branded checkout, our prior outlook assumed a more stable e-commerce environment and a certain pace of product rollout and merchant adoption. Neither has materialized to date as we anticipated, and while we can point to a number of constructive indicators, it's hard to call the precise time frame when we will see an overall inflection for branded. Branded checkout represents over half our profit dollars, and we're confident the product, channel, and marketing investments we're making will drive improvement and acceleration over time. There are also multiple paths to deliver attractive growth. Venmo, PSP, omni-channel initiatives, and credit are all levers that can contribute to TM dollar and EPS growth alongside branded improvement. Our overall value creation framework centers on driving volume growth by closing the online branded gap with e-commerce, increasing penetration offline, and keeping MAA growth and customer engagement at the center of our KPIs. We are strengthening and investing in our core, building out new growth paths like BNPL and Venmo, while staying at the forefront of next-gen growth drivers, including agentic, PayPal World, ads, and crypto. We are also driving process improvements and using AI to leverage our cost base and redirect spending to innovation. All this will help us deliver higher levels of EPS growth, grow free cash flow in line with net income, and apply disciplined capital allocation to deliver durable growth and higher returns. The business has already proven an ability to deliver at least mid-single-digit transaction margin dollar growth and double-digit EPS growth, even in a challenging branded environment. The investments we're making in 2026 are designed to strengthen that foundation and position us to sustain and build on that performance in the years ahead. We have the financial flexibility to make these investments while returning capital to shareholders, and under Enrique's leadership, we're confident in our ability to execute the action plan Jamie laid out. With that, let's go to Q&A. But before we open the lines, I'd like to ask everyone to limit themselves to one question.
All right, here we go.
So we can get to as many of your fellow analysts as possible. Sarah, please open the line.
At this time, I would like to remind everyone, in order to ask a question, press star, then the number 1 on your telephone keypad. We'll pause for just a moment to compile the Q&A roster. Your first question comes from Tien-Tsin Huang with JP Morgan. Your line is open.
Hey, thanks so much for taking the question here. Just you went through a lot, so thank you for all that. I want to ask on the change in the CEO and the timing here. Just maybe Jamie, or can you give us some assurance that the change is primarily to address execution rather than strategy? Because I'm getting questions from investors asking if there's still risk of wholesale strategy changes once Enrique comes in that could delay or extend the turnaround further here. Thank you.
Sure. Good morning, Tien-Tsin. So the board's decision is based on execution. You know, they have been discussing this for the past few months. And when you look at the company, there's really good progress across innovation and, you know, a handful of different areas in the company. And you heard us call those out in our prepared remarks. You know, having said that, our execution is just too slow. And, you know, both the board and Enrique have been deeply involved in setting our plans strategically and around our initiatives. And that carries into what our execution plan is in 2026. And so when you look at Enrique, you know, Enrique has a very deep track record in not only innovation, but operationalizing innovation at scale and driving really complex tech-forward transformations. And so his background and who he is around faster decision-making, clearer prioritization, more disciplined execution, which, you know, really we need that leaning into branded checkout, I think is going to be very, very helpful. And I think the other accelerant here that will be good is, having been on the board for 5 years, having been the chairman for the past 18 months, he just brings a level of depth and immediate context, which really should help shorten the typical cycle that you'd have in a new CEO coming on board.
The next question comes from Ramsey El-Assal with Cantor Fitzgerald. Your line is open.
Hi, thank you very much for taking my question, and I second Tien-Tsin's appreciation about all the granularity here. It sounds like you're quite confident in your strategy around modern online checkout, and meaning you see the offering itself as pretty effective and compelling. The issue seems to be getting the merchants to engage and implement it. So how do you do that? How do you get them to adopt it? Is it a question of incentives? Is competition keeping them from engaging? Like what can you guys do to sort of force the issue a little bit?
Engaging with merchants really takes on a lot of different flavors. And whether that's a large enterprise, a small business, merchants want different things. They want to grow their business. They want to bring in new customers. They want to improve conversion. And so honestly, every single conversation we have involves a different strategy with respect to how we approach it. And that can range from really driving our merchant integrations to the latest integration and getting more conversion, combining that with our consumers on biometrics and passkey. It can really lean into upstream presentment around buy now, pay later. And again, more customer acquisition strategy, all the way over to how do we co-market together and how do we pull people in, customers to engage and habituate not only around us, but equally importantly with them. And so all of that are parts of these discussions. When we've looked at what we've learned over the last several months, I think one of the big things we learned was that we have been trying to do this across all merchants all at the same time. And what we have done now is really reformulated our teams around dedicated mission-based teams, particularly for high impact merchants, and really leaning into the latest integration, really deploying experience and biometrics together, and really going in with an aggressive upstream presentment strategy. And, you heard me talk about it in my prepared remarks, but I think it's worth repeating that when we see merchants with the latest integration, when we see them with upstream presentment and a second button, and with that co-marketing, like that combination drives markedly higher performance for us with our merchants. And we saw that in the holiday season. So there's multiple ways to win here with our merchants, but each is unique, and that's exactly why we're organized the way we are going into 26.
The next question comes from Darrin Peller with Wolfe Research. Your line is open.
All right. Hey, guys, thanks. Maybe just a quick clarification in terms of the timeline you'd expect some of these investments to help come to fruition, and just helping frame a little bit more on if you're expecting TM dollars and branded to improve in the back half of this year, or is this more of a 2027 story? So in other words, exiting the year, should we start to see any evidence of success? And then a bigger picture question would just be your thoughts on balancing between really a growth company and capital return story. I'm just curious if that's changed at all in your framework of how you think about investments in the business, capital investments going forward.
Hey, Darren, good morning and thanks. Why don't I tackle the first question on transaction margin, and then Jamie will handle the growth versus capital return part of the question. On TM, think about the full year. We talk about a slight decline. We talk about that really coming from a consistent contribution from PSP and Venmo, offset by the roughly 3 points of headwinds from those increased growth investments. And then also we have a 1 to 1.5 points of lower interest. There's a bit less contribution from Omni given credit normalization and tougher comps. And then I would call DXO a neutral contribution given the slightly positive to LFC growth we're talking about. This is pretty, smooth as we go through the year in the sense that, you have our 1Q numbers that we lay out there. Those investments have already started, so they will hit us in 1Q and through the course of the year, as opposed to us calling for kind of a back-end loaded year. We're not doing this at this point, and I think we're going to need increased visibility from how each of these initiatives and the new incremental investments are performing. We learned a ton in the fourth quarter from the investments that we made, and those were incredibly helpful. We'll apply that through the rest of the year. Jamie?
Yeah, and then Darren, with respect to balancing between growth and capital return, listen, we've got a collection of really unique assets here, and our focus right now is on transforming this business and really growing the assets we have and investing organically. In addition to that, we've had a strong capital return profile over the last couple of years with $6 billion in buyback, the initiation of a dividend, and continuing that program into this year. You know, the board discusses and is involved with our capital allocation strategy on a regular basis. And part of Enrique coming in really is to lean into continuing to improve and grow our businesses and doing that through prioritization, through better execution, and really being very choiceful about where we're placing our bets.
They didn't
The
answer
next
either
question
question.
comes from Sanjay Sakhrani with KBW. Your line is open.
Thank you. Good morning. I just want to follow up on some of the questions that have been asked. Maybe just a little bit more embellishment on what's included and embedded in the 2026 outlook, given it's a transition year. I guess when we think about the underperformance in branded volumes, some of it's been the lack of upgrading merchants, macro, and then maybe others taking share. Like, which parts can actually turn the corner as we move through 2026? And then just on Tien-Tsin's question, is it fair that Enrique was involved in the process of sort of setting the expectations, so we shouldn't expect a big change after he comes on? Thanks.
Why don't I start with your questions around 26, then I'll hand it over to Jamie for the second part of your question around some of the branded and board decision process, Sanjay, and good morning. First, just running down the kind of P&L for a moment for 26 to give everybody that color. We talked about a slight decline in TM, ex-FBO, that's roughly flat. Call it about 3% increase in OpEx for the year. That gets you to non-GAAP EPS of the low single-digit decline to slightly positive. GAAP EPS of mid-single-digit decline. Tax rate assumption, call it 19 to 21%. And then we provided the free cash flow story when you move over there. CapEx, about $1 billion or so. And then within all of that, OVAS about flattish for the year, low single digit, by the way, in 1Q. TEs at a bit of a lower rate versus 25, so call that about 88 bips or so versus 89 this year. TL in line with 25, so call that about 7.5 bips of TPV, and creditor loan losses of about 2.5 bips, which is another half bip or so. So those are the numbers. Jamie, do you want to hit on the kind of how to think about branded and then the board decision?
Yeah, with respect to branded, you know, as Steve mentioned earlier, when we execute on these investments, we have included the cost of the investments, but we have assumed minimal in-year benefit from those. And when you look at the traction side of it, certainly the changes we're making in go-to-market and traction around all elements of merchant integration, upstream presentment, all those different pieces will begin to gain traction as we go throughout the year. As we go live and merchants go up, we test, you know, we start to see where we can adjust and pivot and optimize. But that will just continue as we go throughout the year. What I'm really excited about is Enrique coming in. I think the prioritization element here for us is really important. We have lots of good ideas. We love to do lots of things. And I think us getting laser focused on what to go after and where with respect to branded is going to help us get even more traction sooner. And then with respect to Enrique's involvement from a strategy perspective, look, he's deeply involved in it. You know, he has helped shape and reviewed not only the capital allocation strategy, the investment priorities that support them, but also the 2026 guidance. And he is coming in focused on the acceleration of our plan and just continuity and building on the work of the team.
The next question comes from Andrew Schmidt with KeyBanc Capital Markets. Your line is open.
Hi, Jamie. Hi, Steve. Thanks for taking the question this morning. So obviously the branded checkout piece is a function of both the consumer and the merchant experience. Maybe you could talk about whether, and obviously you're addressing both pieces, but you think the shortfall is attributable to one side or the other. Obviously heard the the slowness in terms of the modern checkout experience, et cetera. But I'm curious if there's attribution more on one side versus the other? And then just if you could drill down on the consumer side, just core PayPal trends, account acquisition, TPA, PSP trends, and then also the need to perhaps drive a more holistic experience versus the transacting experience on the consumer side. Maybe talk a little bit about how all that's resonating. Thank you so much.
Sure. Let me talk a little bit about the first part of your question, then I'll turn it over to Steve for the account trends and some of that, and then I can talk a little bit about loyalty and some of the other programs that we're really focused on in 2026. With respect to branded checkout, in the second half, we began to see some slowdown really in September, and that really persisted into the fourth quarter. We saw weakness in U.S. retail. People have talked a lot about K-shaped economy, and we're really a middle-income demographic as it relates to the PayPal brand. And so certainly we felt that in a slightly more pronounced way than others. We've had moderating international growth, including in Germany, and deceleration in high growth verticals. We've had really strong growth over the last 18 months in places like travel, ticketing, crypto, gaming, things like that. And not only did we have tough comps, but those slowed a bit in December as well. And so all of this has been amplified by execution, by slower product deployment. So when you level back up to sort of merchant versus consumer, I'd say it's a play of both. And, really it underscores our need to get our experience, further out into the market with our merchants, the latest integrations, and consumers using biometrics and passkey, and the presentment that we've talked about, and really leaning into things like co-marketing and loyalty programs.
Andrew, to your question on transactions per active or TPA, ex-PSP, it was growth of about 5%, which is in line with prior quarters. Think of the consistency quarter to quarter in branded, P2P, plus improvements in Venmo. And then we continue to be encouraged by the strength on the PayPal debit card engagement front as well. So positive here. And maybe this just brings me back to talking a little bit about the focus on quality in our consumer base, and that's indicative of that. The strength in PayPal power users, the idea that we're really going for more and more depth of engagement with our customer base as a key differentiator, as opposed to just simply adding folks who are not durable or we're not able to drive deeper with.
Yeah, and then just coming back to the loyalty question, which I think is really most relevant to the third question you asked. We have been or are introducing competitive rewards programs for both PayPal and for Venmo. Venmo, we launched a couple of months ago. It's a program called Stash, and it's changed our onboarding. The program is about stepping up in levels as you come in, really incenting behavior around using our debit card, stepping up to credit, and more rewards the more you work in and around our Venmo ecosystem. It is super cool. The onboarding process is very engaging and catchy, and we've had really good progress in our first several weeks on that. The other piece is PayPal Plus, and this is something we've been working on for over a year, really doing deep industry benchmarking. We really want this to be a very competitive program. We soft launched in the UK a couple of months ago, and so while it's early, we're seeing some good cohorts of results come through there. And this rewards you for not just what you buy online, but also what you buy offline, in sending money to friends, dabbling in crypto, things like that. And again, rewards, but also, some pretty unique characteristics around it with special drops of access to, whether it's a deal or whether it's some other thing. This will be a global multi-year rollout and part of the incremental investment we talked about. It began, as I mentioned, fourth quarter for Venmo and PayPal UK, but really, I'd say second half, mid-year to second half, is when PayPal Plus will come out for us. Early reads, super encouraging. We're just seeing nice TPV lift up across consumer cohorts that have come on board. But again, something we're pretty excited about.
The next question comes from Harshita Rawat with Bernstein. Your line is open.
Hi, good morning. I think the question, which is in investors' minds, is whether the branded business can be turned around or if the ship has failed. Besides the macro, you have intensified competition. E-commerce is aggregating into platforms where in aggregate you have smaller share. I know you talked about presentment, experience, and rewards as kind of the key areas of execution. And maybe, I guess, talk about upstream presentment. Feels like PayPal historically has been a premium offering. Competitors are catching up on value proposition. But does it all mean that transaction margin dollars and branded will come down as you focus on upstream presentment? There's a concern on price-based competition as well. And also, it's hard to, at this point, kind of narrow the range of outcomes in branded. I know you talked about Venmo and PSP profitability. Can PayPal grow earnings if branded doesn't improve from here? Thank you.
Yeah, so there's a lot there, and maybe I'll talk first about our approach with merchants, and then I'll move over to talking about sort of the multiple ways we can win. With respect to upstream presentment, and let me just talk generally about the investments we're making. These clearly are multi-year investments. You look at these kinds of programs, and these are deep, going in to co-invest with our merchants to really shift how we perform for them and candidly bring more value to them. And so what you see in 26, we fully expect that this kind of investment level will be consistent as we go into the few years following. And we think it's really important because we've really got to lean into the product, both in terms of having it deliver what it needs to deliver, but also remain competitive, as you mentioned. Having said that, when you look at the company, I think one thing that 2025 really illustrated for us is that we do have really strong assets across the board. Between Venmo, PSP, debit, and credit, we've really diversified our revenue growth sources as well as our margin growth sources. And so even with a low mid-single digit branded checkout profile in 2025, we delivered very solid transaction margin dollar growth. We delivered mid-teens earnings per share growth. And so I think there continues to be a lot of ways we can win here. And again, I'm particularly excited about the acceleration in our execution and the galvanization around that we'll see this year with both investment and with Enrique.
The next question comes from Dan Dolev with Mizuho. Your line is open.
Hey guys, thanks for taking my question. I mean, my question is kind of going back to sort of, buybacks versus investing. I mean, the key question I'm asking, and we're getting from a lot of investors, is why not just focus 100% on, on the merchant and just, kind of drive as much growth as you can? I mean, is there, what is sort of the puts and takes of that? Because you do have like this very strong two-sided network that's really powerful and global. And so obviously everyone sees the opportunity. So what prevents you from just going all in on that one? Thank you.
The most important thing we've got to focus on right now, Dan, is improving our own execution and doing that with the investment dollars we have today. And as we prove that out, increasing that or shifting that or reprioritizing and doing different things with it. And I think you've got to have a balance on that between merchants and consumers. I think one of the great things Alex did when he came in was really focus on the different cohorts of how we work in the market, which is large enterprise, small business, and consumer. And having a dedicated consumer team was really important for us because, we have really drilled into where and how we win. As Steve talked before about power users versus active loyalists and just understanding our consumer cohorts better. We know that we win with consumers when we've got a great merchant product, but we also know that merchants win when we bring the value of the consumers and that whole consumer base to them as well. So we've got to focus on both. But clearly in the investment dollars this year, it's clearly very merchant focused.
And Dan, I would just add that this debate and question that you're raising is one that we debated, you and I, and many other investors over time. I think it's our view that you can't win without both. The consumer, you've got to bring strength with the consumer to these merchant negotiations and discussions. It's one of the major reasons merchants want to work with us. And at the same time, you need to bring merchants to the consumers as well. So both are absolutely critical.
The next question comes from Jason Kupferberg with Wells Fargo. Your line is open.
Good morning, guys. Thank you. So I know Enrique hasn't officially started yet, but he's obviously pretty familiar with the company. So just wondering, are all options on the table here with respect to creating shareholder value, potential asset sales, et cetera? And then can you just clarify on the branded outlook for 26? I think you said slightly positive, but does that represent a little bit of an acceleration versus where you exited Q4? Thanks, guys.
Yeah, what we said on the branded outlook was that it would be slightly positive to low single digits. And when you look at January quarter to date, while the environment continues to be dynamic, quarter to date, we're running slightly better than we were in the fourth quarter. Turning to the question on, asset sales, things like that, I guess what I'd say is that we are really focused on transforming the business and driving shareholder value. And right now, that means executing on our integrated strategy. We've got several unique assets. We've talked about that, Venmo, enterprise payments, things like that, and both are core to our value creation and are performing well. And they reinforce them and they complement our portfolio. So right now, our current plan is to really drill into that. The best way to create value is to improve yourselves organically, and we're gonna be very focused on doing that.
Hey, Sarah, we are past the top of the hour, so I'm just going to turn it over. Jamie, any final thoughts that you have?
Yes. So first, thank you all for your questions. Over the past 2 years, this team has laid important groundwork and built significant momentum with meaningful opportunities ahead. And at the same time, we operate in one of the most competitive tech sectors, which makes disciplined execution really important to fully realizing the competitive advantages of our scaled two-sided network. And I'm really proud of the progress our team has made. And I have strong conviction that we're on the right trajectory to accelerate growth. And again, I want to both thank Alex and welcome Enrique, who brings deep experience leading large-scale organizational transformations, along with strong innovation and operational discipline and a clear understanding of our current priorities. And his familiarity with the business and track record of execution is going to help us move faster and with greater clarity as we enter this next phase. And I look forward to supporting a smooth transition and sustaining our momentum. So thank you.
Thank you. This concludes today's conference. Thank you for participating. You may now disconnect.
All right. That was something, huh?
Let me just close out before I have to board.
Yeah, Neil, go.
It's going to be a long year ahead. That's for sure. I mean, my shares will be sold probably at the open, so they put the order. The options, I'll see what I'll do, but I'll cover everything later today. Probably I'll add some necessary humor because otherwise we'll all be crying ourselves to sleep. But yeah, this call was not that reassuring. But then again, when you don't have the incoming CEO share his own thoughts during this call, it's not the greatest thing. Plus, he's not going to share any thoughts in the next analyst conferences either. So hopefully he has an event somewhere in March when he takes over. So we know a little bit more about the dude. But other than that, I have to go. See you all later. Thanks, Roy and Amir, for doing this. And yeah, can't always win, I guess.
Yeah, that's Couch Investor. If you guys don't follow him, great follow, brilliant mind, well worth following. Sharing the pain with us, although pain no more. He is out. I am out. Amir, what about you?
I'm gonna be out too. Just quickly, I agree. That was one of the worst calls where they padded like 80% of it just reading off of the presentation. Didn't really get any information. I was kind of looking forward to it. Like, okay, here is your chance. Make some statements. Make some impact. Be like, okay, here's the clear plan. We're gonna do this now. Like, it starts here. Like they got the analysts actually asked some pretty good questions. Like, okay,
They did.
I like the one like, okay, are you going to be changing strategies? That's what we discussed. Like, okay, we have a new CEO. Is he going to change everything around? Is he going to continue on? They're like, well, he's on the board. He's been a director. So you can pretty much expect the same thing. Okay, that's something, going for it. And we all agree that, well, the strategic vision is there, the execution isn't. Okay. The more important one was like, okay, well, why isn't it working? Why are merchants not engaging with you to implement new features? Because they can develop features all they want, but if the merchants don't implement them, then you get this like situation where they are on legacy platforms and the consumers have a bad experience and you can't really do anything about it. And they're like, well, we were going through all merchants simultaneously, and we found out that that doesn't work. We now have a dedicated team for high impact merchants. And they really kept talking about biometrics and, experiences. They didn't really tell us exactly what went wrong and what will change. They're just like, yeah, we have a team doing it now, but it's not like, okay, we found out that we have scheduled it so it should be done by Q2, or it should be done this year, so we have that behind us. We got no clarity. They're like, yeah, we can't really deploy it across all merchants at the same time. So non-answer, and that was really the whole call, non-answers. A good analyst asked, oh, okay, is 2026 another transition year? And then he said, is this a growth story or a capital returns company now? And as for is 2026 a transition year, they basically didn't answer. They said, "Oh, we don't know how it's going to go. We'll see. We don't have vision that far out." So basically, a non-answer. So that just says that 2026 is going to be a transition year. And I'm like, well, is this a growth story or a capital returns company? And they were like, Jamie Miller came on and was like, well, we have some unique assets. We're going to be investing organically. I'm like, what are you even talking about? She went on for a tangent. I'm like, dude, you didn't answer his question at all. This is a very important question. How should we think about PayPal? Because this was the profitable growth story. They're not really materially becoming more profitable, and they're certainly not, really growing. So okay, how do you frame it now? And we didn't really get any answer. So there's a lot to digest in terms of the numbers. The 10Q is going to be out, going to be able to dig through. Hopefully we'll get some words from the new CEO to see okay, what does he have to say about the company? But the earnings call, pretty bad. No real answers about anything. A bit of a waste of time. Earnings, horrible, to put it mildly. Thesis changer, perhaps I'll have to review deeper, and then I'll share my updated thoughts when I had some time to sit through it a bit more detail.
I'll probably just do 2 more videos on PayPal, period. Maybe down the road. I'm always happy to change my mind on the company, but I won't touch PayPal probably ever again. I mean, they could do things that change my mind, even at higher prices. But I've sold all my shares, looking to exit my options as well. I do think it is still incredibly undervalued, but valuation is not enough of a thesis, especially with this earnings call. Honestly, Amir, it really frustrates me. A lot of companies, when they're changing CEOs, they don't wait for the earnings call to do that. And that would have been if they changed CEOs, you know what? The stock would have gone down, I'm sure, because hey, what's going on? This is not great. But at least it could set up like this. This is a shock the world type of thing, but not in a good way. Had they just said, hey, we're not even going to do earnings this quarter, I think the stock would probably be about the same level. The earnings call was a disaster. Analysts asked great questions, a lot of non-answers. Jamie Miller had the gall to say that they have good momentum. It's what are you talking about, lady? What in the freaking world are you talking about? There is no momentum here. You've had poor execution for a long time, poor communication. Your guidance is abysmal. Sandbagged, I know. They're going to probably do better than guidance. They're not. I mean, it's priced like a company that's going bankrupt. That's not the reality here. But it's an opportunity cost. It's a value trap. I don't want in, especially with a new CEO come in. Guess what, guys? Transition year again, and maybe again and again and again. That's a painful thing. And those things that are the most exciting opportunities for PayPal, they barely even mention them. You would not know from this earnings call. You're wait, they have ads? Maybe.
They have agentic? Well,
Agentic
we know
commerce
that
is kind of too far out, but yeah, they
we,
talked more
we
about that than anything. So, and there'll be a player in there too, but yeah. So
well, we know
it is
they're
what it
into
is, and
biometrics at least. If lost count,
and,
at least 10
and
mentions.
probably a few weeks from now I'll do one other. I'll do a PayPal video just later today, just in case somebody missed this call, just updating why I'm out and everything. But then the other one will be like the anatomy of what went wrong here, and I'll probably wait a few weeks just so it's based on numbers and calculation and everything that there's not emotion there. I mean, I'm frustrated. Like this is a disgusting quarter, terrible execution, and shame on you, PayPal.
It's good to get grounded sometimes. I think as painful as it is, I think it serves as a good reminder, because I believe that most people who are watching YouTube investors like Amit continuously, you see Amit win after win after win after win after win, and you have this perception that oh, the stock market is easy money. Like, no, like this seemed like easy money, like on paper. It's sometimes good to get grounded again and realize, okay, like this is for real. Like, it is not easy to be an investor. It's not easy to make decisions. So for me personally, it's good. I can't even recall my last loss. Like, this is the first one in recent memory actually that I'm got wrecked on properly. So this is a good reminder that the markets are unrelenting.
And even and Amit's a great example because he is just absolutely brilliant. But Grab, it's been a very lackluster. I think he'll be okay. I think it's an okay play, but every single investor out there has mistakes and missteps. So guys, if like you're newer in the market, this is your first one, don't think like it's all rigged or you're a terrible investor. Learn from this, grow, improve. I know that I will too. I mean, that's what this is all about, is continue to learn and grow. The best investors in the world have things that they get wrong. They just do. Now, some people that you follow on X or on YouTube, you wouldn't know that because it's like, oh, they always get like 100% winners like every single month and they never get anything. No, that's not realistic. The realistic is investing is hard. Find the best companies and invest in them long term. PayPal ended up not being that. So, yeah. Yeah,
Nicholas, I
and
think he made a good point there about the guidance not adding up. You have to keep in mind there, when they made that guidance, they have to account for some appreciation. It's not like they know that the stock is gonna tank 20% and they can be like, oh, okay, it's gonna be this amount of increase of 30 billion. They're probably expecting the market cap to go up from when they made it. So return this minus 70%, add some percentages, and then it maybe will make sense mathematically. But yeah, very, very strange things going on with PayPal these days.
yeah. Drunken Miller is one of the best, and yeah, he there are some things that he
Everyone,
absolutely
yeah.
got destroyed on, like everybody does. So I'm not saying this like oh, you guys need to listen to me because I got this wrong. Frankly, I did. I was absolutely
Yeah,
100% wrong. Um, and that's
but look,
also the importance of doing your own due diligence. There are things Amir and I get very, very right, but if you don't have the conviction and you've not built your due diligence, or if we're wrong, like do your own homework, guys. Very important.
look, if you decide to take a loss on PayPal and then you just move on, you really lost out. If you actually learn something from it, like review your decision making, what went wrong here, how can I prevent it in the future, what could I have done differently, and actually take some learnings from it, then it's not like a pure loss in that sense, and you're likely mitigating similar situations in the future as an investor. So as long as you learn something from it, I mean, everyone takes losses, and as Charlie Munger so famously said, like, you never stop learning. Like, he was 90 plus, still learning things every single year, investing. So as long as you learn something, it's not a pure loss.
Yeah. Yeah, and in that, again, I'll have that video, probably a few weeks out, as far as like an after action report of like what went horrifically wrong, what were the early signs, what did I miss? There's plenty there that I missed. So, I have been pretty bearish really since the prior quarter, and especially those fireside chats that came over. I did trim some options before, but I didn't expect this, guys. So it is what it is. Any last thoughts, Amir?
Yeah, thank you so much for hanging out. Thank you, Roy. Thank you for our other two co-hosts, Couch Investor, and I forgot the X handle, Juan.
Oh, Juan, yeah.
Juan,
let me
yeah.
throw those up. Actually, that's a good call. Yeah, Juan was with us earlier. So here is his. He is
Yeah, he's
really
been covering
good follow.
PayPal a
Small
lot. I follow
account,
him.
but if you like small accounts, like very, very good research. Some of those guys actually do the best research. Let me throw up Neil here real quick. Of course, Neil is also on YouTube. And here this is.
I think most
Neil?
people here are on Neil's channel actually watching us.
Yeah, I think so. But
So
on
you
our
don't
channel,
need
just in case you're not.
the link to Couch. You
And
guys should be
Amir?
finding me and Roy. Go crossroads and go
Yeah.
to my channel, guys.
Yeah, I won't throw mine up. You guys can find me if you want. But here
Yeah,
is
same.
Amir right there.
Ah,
Nice.
thank you.
All right. Well, we're gonna call it good, guys. I've got a
Yeah.
day job, and I need to get started and focus on that, which is Tuesday's my busiest day. So thankful because I don't have to think about this. I already made my move, sold, anyway, hang in there, guys. Thanks
Yeah.
for being with us here today. Happy investing.
Bye, everyone.